That's interesting because I'm no stranger to the industry myself, but I have to admit I'm not familiar with CIM. And
Richard, I think you're on mute.
oh, you're probably right. You're right. I am on mute. So okay. Well, I was just saying I have to admit, as embarrassing it might be, but I'm not familiar with CIM. So took a quick look at the website, and it appears I'm missing out on something. We're at $30 billion in assets under management, so that's no small player.
Yeah, and it's honestly, so when my team talks to financial advisors, even large institutions, when we ask them, "Are you familiar with our organization?" It's a pretty common response to see them nod no. But the two things that I want you to remember, if anything, from today's conversation is we are an established organization and we're very disciplined in how we invest. Part of the reason why folks aren't as familiar with our firm is when we started back in 1994, so going to the established piece, we were primarily working with large institutions. So endowments, foundations, sovereign wealth fund managers, those were the individuals that were investing with us, and we were very specifically doing investment deals for them. So since 1994, we've actually grown quite a bit. We have we have over $30 billion invested in our organization, but we've done over 60 billion in commercial real estate transactions since our start. Back in 2018, we actually brought our institutional platform to the private wealth side of the business and started working with everyday investors like you and I. So what that means is we essentially brought our private funds and made them more accessible by lowering suitability, lowering investment minimums. And I think when I reflect back on the coursework for the SIE, the alternative space, I think, is maybe one or two chapters in the whole book. But it is a really large competitive space. So CIM, kind of to put it all into context, we're not Apollo of the world. We're not the Blackstones, but we're the 25th largest real estate manager in the market today. We have, and I will, let me see, pop over. Let's see if I can figure out how to move slides. We have over 1,000 employees in our organization, and there we go. We have 1,000 employees in our organization today. We were originally, or we are home officed in LA specifically, but have branched out to the Phoenix market. We have about 200 employees here in Phoenix, but then we have corporate offices worldwide. So we have folks out in London, in UK, in Japan, in Australia, in San Francisco, Dallas, etc. So we certainly have a global footprint. But I think what really makes us unique to other competitors or alternative sponsors in the space is the fact that we do it all in-house. So one of our key competitive advantages is the vertical integration within our organization. And that's just a fancy term or a way of explaining that we do it from acquisition to disposition. So we have an entire group of individuals raising capital for the organization, which allows us to buy the real estate, infrastructure, and credit that we're investing in. But then we have all the folks, the infrastructure in place to manage that. So we have a leasing team, we have a property management team, we have construction, we do development, we do it all to the point that when we actually go sell the asset. All of our portfolios are packaged into either a public or a private fund strategy. So it's either in an LP format or in a mutual fund wrapper. And essentially, what we invest in is what delivers a return to our shareholders. So think about it this way. If I'm buying a single tenant office building that's 100% leased to Uber, which we own their headquarters, right? We're going to put that into a fund because it's fully occupied, right? We're collecting cash flow. And in a REIT strategy, you are obligated to pass through 90% of the net operating income to the investors. So anything with high occupancy that's already really developed is going to be a very core or bond like strategy. It's there to just create consistent income with minimal NAV growth, right? We may see a little pop on the NAV when we go to sell the real estate if it's done so, at the proper time. But generally speaking, it's an income-oriented vehicle. On the flip side of things, if we're working we're working on developing a hotel asset, right, and doing it ground up, you can anticipate much higher returns, right, because you're taking on a lot more risk in that investment. But as a result, you're rewarded for that risk. But you're not going to generate any income until that building is fully operational and a tenant is in place. So what's really cool for our sales team today is CIM. We started off with really opportunistic development strategies, but since then have really grown our platform to do everything from a risk reward profile. So when we're working with financial advisors and their clients, we have the opportunity to really consult and understand, okay, what is it that you're looking for? And is there a strategy here at CIM Group to help kind of achieve some of the things that you're looking for in your portfolio? So for our conservative investors, it's typically income. For our younger investors, it tends to be a little bit more of that double-digit return, opportunistic type return. So our sales team is well equipped to have multiple conversations. Any questions around that? Who we are, what we do?
I'd say pretty impressive so far. I'm hoping everyone's able to keep up with what you learned in Chapter 7. Because,
Is it
uh-huh.
Am
Well,
I keeping it simple enough?
well, I think so. For folks who've had the chance to study this, right? Because we were talking about real estate investment trusts or real estate limited partnerships, REITs and RELPs.
Yep, that's exactly what we're talking about.
So here's something right coming out of the textbook and into real life.
Yep, exactly.
Okay.
And it's unfortunately just a small piece of the pie. But that is what we do here at CIM Group. So we have a 30-year track record. We started off in the real estate space, and then over time have grown our platform to credit and infrastructure. I would say the one unique thing for our firm as we continue to grow and where we see opportunity moving forward, with real estate valuations being so high, you're actually seeing us position a lot of our portfolios more into the credit space. And to date, we're actually one of the largest non-bank lenders in the US. So if you guys recall back in 2012, a lot of the banks got in trouble for overlending. What happens today is there's a lot more limitations in which banks are feeling comfortable to loan to. So they come to firms like CIM Group to get that additional credit piece or that additional loan. Benefit to us and our shareholders. We do so at a higher coupon. And I would say the last thing, especially Richard, if you're looking at our website, so just that's a little bit about who we are, our track record, how we invest. So all of our strategies are centered around a community-based approach to investing. So we go out to enhance the communities that we're investing in, either through real estate or infrastructure products, but it's based on the needs of that community. So you see a lot of the areas in which we invest is in growing urban areas, like Dallas, for example, but we do it based on need. So we're not just an office developer, right? We can go into these communities and assess, all right, for Arizona specifically, there's this need for multifamily housing, right? There's a shortage of places to live here. And so we can go out and develop that way. In Dallas, it was office. In San Francisco and the greater part of California, we've been doing a ton of infrastructure work. So it allows us to be really nimble, but then allows us to work through various market cycles because we just don't have one specialty. We can kind of do it all and adjust based on the needs of the market. All right, so this is just a little snapshot of the alternative landscape. So when you're talking to clients and or financial advisors, the alternative landscape can mean a lot of different things to a lot of different people, right? And so this chart is essentially showing you the different ways in which you can access alternatives. And it's going to show you the amount of risk you take on. So on the left-hand side of the screen, low to high, and true. This shouldn't be a surprise to you. Lower risk, lower returns, right? Higher risk, higher returns. And when we talk about the alternative space, when we talk about higher returns, higher risk, that also means giving up a lot more liquidity, right? So that's the biggest disadvantage when we're talking to the market about why people should be investing with us. It's due to the nature of the investment and the fact that it's not that easy to get out of. But if you think about what you're investing in, right? Selling an office building tomorrow might not make a lot of sense, and it may not be easy to do so, which is where we would get the liquidity for our shareholders. So on the left-hand side of the screen, you can absolutely access alternatives through a general ETF or a mutual fund. So V&Q is a really well-known publicly traded REIT that's offered through Vanguard. That could be purchased electronically in most of your brokerage accounts, no problem at all. It's going to give you some exposure to real estate, but it's going to move a lot like an equity, right? So if there's volatility in the marketplace, that mutual fund is going to move up and down in tandem with the market. The more liquidity you give up, the more benefit from the alternative that you get. So CIM, we introduced interval funds to the market. That was our way of working with everyday investors. It's a mutual fund strategy, but redeems in intervals, so in quarters. But you can purchase that fund for as low as $2,500, and it's also done so through a ticker. And then you keep moving up the chart. The more liquidity you give up, the higher the returns. But we have an entire platform of mutual or private fund strategies, or LP structures, which is where we probably raise the most money in the organizations, and each of those funds invests a little bit differently. So that's a little bit of the alternative landscape. I would say, hey, look, generally speaking, when we are working with a financial advisor or their client, we're looking for a small piece of the pie, maybe 5-10% overall an entire portfolio within, a fixed income / equity allocation. Any questions on any of that?
Well, if you can tell us a little bit more about the entry-level positions here that are available. Yep. And once we get our SIE and we got that piece of paper that says pass on it.
So let's talk a little bit about that. So there's a lot of different ways to navigate the organization. I would talk more specifically to, the entry-level roles in terms of the Series 7 and the 63. So it's either done in the front of the house or the back of the house. So let me talk about the front of the house, which is where my umbrella is. We distribute in 3 ways across the organization. That means we sell. It just depends on what group. I have a global team that sells to large institutions, so pension funds, endowments, foundations, sovereign wealth fund managers. I have a team that sells to the private wealth channel, so banks, wires, RIAs. They're all sales-based roles. The biggest difference is kind of the types of the sales process, within those groups. So my global partners team, I always tell the individuals that have more of the analytical hat, that like to do more of the research and get really in depth into conversations when they're selling, this team's for them. When we reach out to Pepperdine University, right, we really only have one shot to make sure we're having a meaningful conversation with them. So a lot goes on behind the scenes to make sure we're having a successful outreach. So we'll understand whether or not Pepperdine's investing in real estate. And if they are and have an appetite for real estate, we'll go ahead and approach that conversation, but then make very specific presentations and have a lot of different individuals across the organization be involved in that conversation, right? Because when Pepperdine's going to move to invest, they're going to allocate anywhere from $50 to $250 million. So it's a really big win, but a slow sales process. It requires someone that has high attention to detail, but also has a little bit more of that analytical mindset in which you want to know all of the details about all of our strategies. Whereas our private wealth group, I would say this team's a little bit more high volume. So they're a little bit more transactional in nature. They're selling our entire platform, but some of our funds for this team go as low as $2,500. So we can talk to an advisor maybe 1 or 2 times, and he'll start doing business with us pretty much immediately. So it's less research, right? More relational, and tends to be a little bit more phone driven. So these are kind of the opportunities within the organization from a sales perspective. For those of you that don't like sales at all, I get that. It wouldn't happen without our fund operations group, which is also licensed. So they run alongside the sales team, but help support our investors kind of on the back end, right? So they help onboard, they help process new business. They help us issue K1s and manage those relationships to make sure our investors are having a really great experience with us. It's a little bit more of an individual contributor type role, but does require licensing as well. So that's a little bit about some of the opportunities across the organization and where you would start. From there, you can grow in a lot of different avenues. I've had folks on my team move from being internal associates to being client-facing associates. I've had folks move in from sales into portfolio oversight or in the investments team, kind of be the people that manage the funds to make sure they're operating successfully. And then there's obviously roles like the path that I took from internal sales into leadership, right? And so helping lead the group and the initiatives across the organization. So there's a lot of opportunity out there. It's just working with someone like me to figure out what your growth path looks like. That's my job in the organization. My team typically sits with me anywhere from 3 to 5 years. And then from there, we kind of figure out what your next journey is.
Very good. Okay. What about our training? How is our training going to work? So first off, of course, we need to get our top-off exam.
Yep.
So that'll be pretty much right, I assume, right off the bat. But will it also be mixed in with we'll also teach you how to use the systems and how to sit at your desk
oh yeah, absolutely. You'll have a lot of time with me. So my team, in order to sell our platform of alternative strategies, it needs to carry a Series 7 and a 63. So we would work on getting you through licensing immediately. And then I would say this is where I'm a little unique. I don't put hard and fast deadlines on the licensing piece, right? Everyone moves at their own pace. You all have different responsibilities at home. I will say the incentive of getting licensed quicker, right, is being able to move into the actual selling role, which is where you're able to increase your base salary, your bonus, and start earning commissions. I can't pay you commissions until you can actively sell. So during the onboarding process, I would say you're spending, call it 2 to 3 hours of your day studying, the other part of your day operating in more of a support type role. So learning products, helping schedule meetings with relationships we already have in place, but it's definitely more of a reactive administrative position until we can get you through licensing to get you officially into a sales position.
Okay. For those from geography is a question, but where are the Phoenix offices located?
We're on 24th and Camelback.
Which is very much our central financial district, except for downtown, right?
Yeah, we're right down the street from Schwab. There's a whole financial hub in that area, Northwestern Mutual and a few others.
Colby, I see that you. Okay. Oh, you work right out there. Okay.
Oh yeah.
Okay. All right.
It's a good spot.
Mm-hmm. Good. Okay. I know things are, of course, ever since COVID world, but are we going to be all 100% in office? Are we going to have a hybrid of remote and in office, or entirely remote? Or
Um, no, so I'm a big culture person. I had my team come back into the office fairly quickly. So we are in office 4 out of the 5 days a week. I give flexibilities 1 day a week, but on Wednesdays. I make everyone do it together. So the rest of the week we're together, kind of working collaboratively, but that's when it's when I structure all of our team meetings. So there's ongoing training, right? There's immediate onboarding, but there's obviously an ongoing need to train. The products are very dynamic, so I like to do that collectively as a group.
I'm curious. It seems like I know you mentioned there's some back end and administrative roles, but for the sales, those kind of seem like the main ones. What's kind of the company's culture with sales? Is it very hard line? Is it you're basically earning your paycheck still, or?
Sure. I'll just be super straight honest with this group. So if you're an external sales representative, it is going to be way more cutthroat in terms of expectations for bringing in money, right? But where you start within my team, it is less that way. I start everyone off at a base salary of $70,000 with a 16% bonus. And then you earn commissions based on the monthly sales of the territory that you bring in. So we pay a decent salary. I say the commission piece is the icing on the cake. So do I want someone that's competitive? Yes, right? But my team specifically, which is going to be more of that entry level position, that's this. At the end of the day, it's your business partner that you're working with that's responsible for bringing the money in. My job is to make sure to coach you, train you, that you're being very successful and supporting the territory that you're in. But there's no capital raise expectations for my team. I actually don't even have like call expectations, if that makes sense. My whole emphasis is a focus on quality and moving the sales process forward. And everyone on my team's at a different point, right? I have some folks that just graduated college, and I have some folks in there that have been in their career for over 15 years. My expectations for those two individuals is going to be different. So I coach accordingly.
Thank you.
Mm-hmm.
okay.
Yeah. So when you say internal and external in the sales process, does that look like meeting with going out searching for business, or doing cold calling, or COIs, partnerships, or?
Great question. So, how would I explain? So it is some cold calling and some relationship management. So I have every internal is partnered with an external. That's your client-facing business partner. We have everything broken down geographically. I was looking to see if I had a map, but I don't have one. So you cover a specific region, so it makes sense for your business partner to be able to travel, but you are not sourcing leads. So what I mean by that, in order to sell to a financial advisor, I need approval on their platform. So when I'm working with a financial advisor at Morgan Stanley needs to approve my product first before I start calling that advisor. So what Morgan Stanley will do once we get on the platform is send myself, the leadership team, a list of all of the financial advisors within the organization that are approved to sell alternative strategy. And we go ahead and upload that into a CRM, which is then provided to the sales team to go through and call, right? So it is a little bit of a cold call in terms of they might not be familiar with CIM, so we need to educate them. But Morgan Stanley has given us approval to give them a call, so they're more inclined to listen. We also know they're already using alternatives, so there's some sort of appetite there. We just got to figure out if there's a potential for us to align with what they're already doing. Does that make sense? Gobi might have froze on us.
Yes, it seems like.
So it's a little different than like a financial advisor who has to source their own clients and leads, right? That's a very hard prospecting initiative. This, you're prospecting, but I will tell you, generally speaking, in this wholesaling side of the business, if you have a good product, most financial advisors are willing to listen.
Thank you.
I don't know, Kobe, how much you heard.
The last part, my Wi-Fi must have went out because I missed the last part, but I did understand
Okay.
where you were coming from by that. Thank you.
Anything else?
So are you actively recruiting right now? And if the students pass this class and they have an interest, how should they go about checking it out?
Bill, what I'll do is after this call, I'll send you over just an email. I know you have my contact information, but I actually, you can email me directly. Happy to sit down, have a cup of coffee, but I'll also provide the links to the there's two positions on my team. The analyst position is the unlicensed one that we would work on getting you licensed. If you're licensed, it would be the associate position, but I'll include both job descriptions so you can look at them both.
We've got a link in the course for CIM Group, and we just need to make sure it's current. So that'd be great.
Yeah, let's double check that. And then you can always circulate my email and my contact information, not a problem.
Okay.
If you start off unlicensed, you mentioned that the license was an associate.
Mm-hmm.
If you start unlicensed and then get your 63 and your 7, do you become an associate, or is it time once after some time in?
Generally speaking, you move into so from the analyst to the associate position within 6 to 12 months. A lot of my team has moved more quickly because I've had more openings. I only have 2, maybe 3 associate positions left. So it's a little bit of if there's an opening, yes, there's the ability to move into the associate role. If for some reason my team is fully staffed, there would be a period of time where you might be licensed, but we're waiting for an opening on the team.
Okay, thank you.
It's a sales role. So like I mentioned to you, I'm 3, 4, 5 years, and I'm usually moving people on to their next step in the journey. So there's never been an instance where I've had an analyst sit more than a year in that role.
Sorry, I have another question. So you said there's 200 people in the Phoenix, 200 employees in the Phoenix region. Are you in the Phoenix region, or do you oversee like across the country for this team?
My team is across the country, but I'm in Phoenix. My team's in Phoenix. The team one part of my institutional team does have a global footprint, but they're still based in Phoenix. They just work weird hours.
I can imagine.
Are the headquarters for CIM in Phoenix, or is it more of a smaller location here?
So LA is our home office. We have about 300 employees there. We launched Phoenix in 2018. We have about 175 employees. The intent is to move our entire accounting team to the Phoenix office, so I anticipate that to continue to grow. No, so we're actually, between LA and Phoenix, those are our two largest offices. And that's the one nice thing about Phoenix having grown so much, is there is a lot more growth opportunity for folks that get hired in a Phoenix. Used to have to relocate to LA to continue to kind of career path. That's not the case anymore, which is great. Also, COVID, we thank COVID for that. I think folks and teams are a little bit more flexible in having employees in different locations too, which is great.
That is good. I think a lot of financial offices here in the Valley, it's more smaller teams. So that's pretty interesting that it's such a large group there.
Mm-hmm. Yeah, you're right, Hannah. A lot of companies use Phoenix as a little bit of a satellite location. So when you're getting to a certain point in your career, you have to move. I would say, depending on what you do, that might be the case, but I would say you can sit in the Phoenix office for a good period of time. Anything else? Well, I appreciate everyone's time. Thank you for your thoughtful questions. I'll make sure Bill gets my contact information out to the group if there's additional questions. Happy to have conversations offline.
Okay.
Thanks, Angelique. That was
Thank you all.
Thank you.
Thank you.
Great night.
Thank you, Angelique. Okay. And it's great to see this opportunity, like I said, to see things come out of the textbook and into real life. In fact, I think that's the first time I even saw a mention about a interval fund. I read about them in textbooks, but I never once saw one. Okay. Thank you so much. Okay. Colby, is that your virtual hand?
I am so sorry. We already said our goodbyes, but you said there are 2 positions open on your team. I know we're not really set to take our exam within another month or so, probably, depending on the test date. How does that process work for if we're involved or if we're interested in this position?
We can talk now.
Okay, wonderful. So
let me send Bill, will you send Colby, or Richard, will you send Colby my contact information?
Yeah, I think it's already Colby. If you look in the course, I think it's already in there. And when you say contact information, you just mean email address?
Yeah, email, my phone. We can bifurcate the recruiting team. I don't mind doing that from time to time. Let me see.
Yeah, if you look in the course and go down to the last module that says career information, your email address is still your former name, correct?
Mm-hmm. It'll go to me.
Okay, and then there's no phone number in there. There's
Colby, you ready to write it down? I'll give you actually my cell, which will be 480-221-6758.
Bill, I just checked in Canvas and I couldn't find the link. Is it in Past Perfect, not Canvas?
No, it's in Canvas. I'm looking at it.
I am on my phone, so that also might be why I'm having a little bit more hard time seeing it.
Yeah, and it's showing that it's published, and you should see 5 different. We're going to have industry speakers next week also, and there's 5 of them listed. So the module is called Career Information, and then there's a link for CIM Group as one of them. So if you're not seeing it, I don't think I can explain why, because it looks like it should be showing up.
Okay, thank you. I'll look a little bit.
Yeah, I don't know if somebody else can take a look and see if they see it or not.
Ashley says she doesn't see it.
How about that?
Okay. If you can enlarge it perhaps for us.
That's great. is this your digital signature? I can use that information.
Yeah,
to add
I
it.
just sent it over and I just put it on the screen if that's helpful.
Yeah.
Are you able to
and
enlarge?
just-
I've got multiple ways to get a hold of me, Colby. The phone number I gave you is probably the best, but these two other work too.
By any chance, are you able to zoom in on that on your SIG file?
Let me try.
On this side, it looks a little too small. To...
Do you work out of that address? I'm up on the 11th floor. I think I've actually visited your office a couple weeks ago for a random reason because we get your guys' mail.
Are you at RBC?
Northern Trust.
Same building.
Yep.
All right, are we all good? Is everything else, anything, get all your questions answered? And if you think of something later, okay. Well, Angelique, I'm so grateful that you were here today and to help us see what's available and to kind of open our eyes to a whole bunch of new different things. Oh, virtual applause from Kimberly.
Thank you.
Okay. All right, for everyone else, I think this is a fine time. Let's go ahead and take a 10-minute break, and we'll be here back at 6:59. Oh, all right, we'll round it off to 7 o'clock. Okay. All right, see you in a few minutes.
Richard, I'm going to take off.
Okay, thanks, Bill. Take care.
Thanks for letting me join.
You bet. Okay, welcome back from break. Okay, and let's go ahead and take a look at a few of our practice quizzes here. So here's one, just again for more practice. And as always, if you need anything about this, if something doesn't quite make sense, unmute, type a message, anything you need. So question one here, the principal difference between an open-end management company and a closed-end management company is A, capitalization, B, management, C, investment objective, or D, expense ratio. Okay. All right, well, Kimberly already started answering the question before I even had the chance to finish. Okay, 1, 2, 3. Okay, 3 people have answered so far. Okay, 4 people. No, 5. There it is. 1, 2, 3, 4, 5, and yes. Okay, good. So everyone's answered. So let's go ahead and check this out. So the principal difference, the main difference now between an open-end management company and closed-end fund, well, the actual answer is capitalization. The difference is how do they raise money in order to invest it. The difference is not what do they do with the money once they've raised it. They may both most have the same management, the same style of management. They may have similar investment objectives. What is the goal and purpose? The expense ratios, basically the cost of doing business, may be the same. The major difference is how they raise capital. Closed-end funds raise capital very much like any other corporation does, right? They'll issue a certain number of common stock, but they can also issue preferred stocks or bonds, much like any other corporation. They'll do a one-time initial public offering, sell shares to ground floor investors at the public offering price. Once the shares are sold out, they'll list and trade on a stock exchange, and they trade like any other stock. Open-end funds, however, right, they do a continuous offering. Every time someone invests in an open-end fund, new shares are created with every purchase, shares that didn't exist before. And they're not limited to how many shares they can sell, so they're not limited to how much capital that open-end fund can raise. When someone wants to sell, they don't trade them to other investors. There's no secondary market. Instead, they have to be redeemed back to the fund for cash. And when shares are redeemed, they are canceled and no longer exist. So new shares are created, old shares are canceled, so the number of shares always changing. Question says, is one active and one passive? Nope, the difference is not that. Now, some open-end funds, maybe even closed-end funds too, might have a passive management to them, passive management strategy, like an indexing strategy. But for the most part, they're actively managed. Yes, it's a special case where they're passively managed. So no, management is not different. It's structure and capitalization. That's the main difference between. All right, let's check our next question. Again, if you need more detail, please let me know, okay? Which of the following terms are synonymous? 1, open-end fund / mutual fund. 2, open-end fund / publicly traded fund. 3, closed-end fund / mutual fund. 4, closed-end fund / publicly traded fund. Is the best answer A, 1 and 3, B, 1 and 4, C, 2 and 3, or D, 2 and 4? Okay, you got 3 so far. 4. Okay, everyone's answered. Let's check out. So which of the following terms are synonymous? What's another word for an open-end fund? What's another word for a closed-end fund? Okay. The popular name or the common name for an open-end fund is fairly known as a mutual fund. Open-ended mutual funds are pretty much just about synonyms. And the reason I say just about is because there are some things that are classified as open-end funds that are not actually mutual funds, okay, such as the sub-accounts of variable life insurance and variable annuities. They're categorized as open funds, but there are some technical differences from mutual funds. What about a closed-end fund? Well, if number 1 is true, number 3 can't be true either. So number 1, so closed-end funds are also known as publicly traded funds, since I just mentioned closed-end funds, when the shares are all sold out, list and trade on a stock exchange, just like any other stock. So 1 and 4 are synonyms. Okay. Again, do you have any questions about that? Okay, again, please let me know if you just need a little more detail, okay? To find the net asset value of a mutual fund, which is deducted from the value of all assets owned by the fund? A, liabilities, B, operating expenses, C, management fees, or D, redemption fees. Okay, no, you can change your answer, no problem. Mhm. Okay, I think we're waiting for one. Okay, so to find the net asset value of a mutual fund. So what is net asset value? What's the definition? Net asset value is net worth per share. Net worth per share. Now, what's net worth, right? Asset, right? What you own minus what you owe, or assets minus liabilities. That determines the net asset value. Now, the liabilities can include the operating expenses and management fees and so on. Not so much redemption fees. Redemption fees are what they charge someone for basically cashing out early. Okay, sometimes like that. Shouldn't have changed, right? Okay, go with your gut instincts. Yes, always go with your gut instinct choice. Okay. All right. So the operating, those can be, of course, liabilities too. Or, but so can things like if they took a loan from a commercial bank, that's a liability too. But fees and expenses that are due but haven't been charged yet, haven't paid yet, those are other liabilities. So, but the best answer is liabilities. Assets minus liabilities is net worth. Divide by the number of shares outstanding is net worth per share, and that's net asset value. Which of the following investment company securities is not redeemable? A, open-end fund shares. B, closed-end fund shares. C, fixed UITs. D, non-fixed UITs. Okay, have we got everybody? Yeah, I think everyone did. Okay. So which is not redeemable? Okay, redeemable means that in order to cash out of it, you got to give it back to the issuer where it came from. So you do not redeem closed-end fund shares. Instead, closed-end fund shares are negotiable, and negotiable means tradable. They are traded between investors. Okay, right, because they bought and sold just like any other stock. Open-end fund and mutual fund shares, when you want to sell, you have to redeem your shares back. Unit investment trusts, if you want to cash out prior to the maturity date of the trust, yes, you have to redeem them back, whether they're fixed or not fixed. The primary function of the investment advisor is to A. Manage the fund, B. Set the investment objective for the fund, C. Safekeep the assets of the fund, or D. Prepare the financial statements of the fund. You got 4 answers so far. Okay. All right, got all 5 answers. The primary function of the investment advisor. What does the advisor do? Manages the fund. Yes, manages the fund's assets. Doing the research, doing the day-to-day management, right? Deciding what to buy, what to sell, right? Doing all the research, investigations. That's the role of the investment advisor, for which they earn the advisor's fee, or the management fee, which is usually the largest single expense that a fund has. The investment objective is set by the fund's board of directors. Remember that open and closed-end funds are organized as corporations, so they're overseen by a board of directors. And the board sets the overall objectives for the fund. They'll say, right, this fund will be just a fund that's only invested in the stocks that pay dividends, or only stocks in the healthcare industry, or whatever it is. Now the board does not do the day-to-day operations or management. They hire someone to do that. They hire the investment advisor. Safekeeping the assets is the role of the custodian, and the accounting firm prepares the financial statements. Yes, Colby.
I'm sorry. What is the fiduciary? I thought that was what the fiduciary does, is manage the fund. What did?
Well, they would have a fiduciary role, as investment advisors. They are fiduciaries to their customers, right, to the investors of the fund. But the investment advisor will manage the fund's assets according to the instructions, the objectives that are set by the board of directors.
Got it. Thank you.
You bet. Next, what is the best recommendation to an investor age 40 who's looking to save for retirement at age 65 and who does not want to spend time managing his investments? A. Unit investment trusts. B. Balanced fund. C. Index fund. D. Target date fund. Okay. Final answer. Okay, Amy, thanks. Okay. All right. This is again one of those things where it's not so much the right answer, but the best answer. Yeah, you can make a case for probably about all of them. But so which one's best? So is someone who basically wants to save for retirement, but does not want to manage his investments. And I say, well, don't they all give it to a mutual fund manager to invest everything? Well, even still, you have to do some your own management as well, right? You have to do your own portfolio allocation. You have to rebalance your portfolio from time to time. But if you want to let someone do it for you, you would choose a target date fund. Because in a target date fund, right, they start off, um, with a longer time horizon. So like someone just starting their careers now, they're probably looking at like target date 2060. So that would be very heavily weighted in stocks with a little bit in bonds to kind of balance things out a little bit. Okay, but then as time goes by, the fund is going to rebalance and reallocate the portfolio, move money away from stocks and more into the stability of bonds as they get closer to their goals. Until, target date 2025 coming up here pretty soon is going to be heavily weighted in bonds for the stability and income, right? And a little bit in stocks to help give the portfolio some growth and keep ahead of inflation. Okay. But even a balanced fund index, see, a balanced fund is just going to have a specific mix between stocks and bonds. And it's not going to change that mix, right? But as people get closer to their goals, what worked for them at age 30 might not work for them at age 60. Okay. Unit investment trusts all have a finite life to them. So they don't last forever. So at some point the trust has to be dissolved. And so people have to reinvest they have to reinvest. So for someone who basically wants the whole autopilot approach, a target date fund be the best fit. A growth fund would likely invest in which of the following securities? A, non-convertible corporate bonds. B, government bonds. C, convertible bonds. D, preferred stocks. Okay, we've got four. There we go, number 5. Okay. A growth fund. Well, what does that tell you right there? A growth fund. What is the goal and purpose of a growth fund, right? To invest in investments that have growth potential, in fact, a high degree of growth potential. The only thing that really has any growth potential is common stock. As the company grows, hopefully the value of their common stock grows too. Preferred stocks are stocks also, right? They're equity investments. But preferred stocks don't look and act like common stocks. They look and act like bonds. So with a preferred stock, you pretty much just expect to get your dividend, and you don't really have growth potential. All the other three are bonds, however, but one of them's got a little something extra to it, right? Right, the one that could be right, that could be exchanged into shares of stock, and unless the bondholder participate in the growth of the company. So I know a growth fund you would think invest in common stocks, particularly stocks of rapidly growing companies. But a convertible bond, well, it can be converted into shares of stock, and it still allows a bondholder to participate in the growth of the stock. So out of these 4 choices, a convertible bond would be the best choice. Do you see how I arrived at that? Is there any part of that that's not doesn't make sense? Okay. I wouldn't choose government bonds. Government bonds are not growth instruments. We use those for income and for a safe level of income. And corporate bonds too. Okay. A little higher degree of risk for a corporate bond for a bit higher interest rate. Okay, but growth has to come from stocks, or common stocks. Okay, now a growth fund specifically is investing in the stocks that the fund manager thinks has the most growth potential to grow faster and further than most other stocks, and investing in rapidly, high growth industries, particularly things like technology stocks. Okay. The front end load on a mutual fund is best described as the A, expense ratio, B, cost of investing in a fund, C, taxation of dividend distributions from investing in the fund, D, taxation of capital gains from investing in the fund. Okay. And I think, yes, I think that's everybody. And everybody chose B. And I agree. The front end load is the cost of investing in the fund, right? It's basically the commission for the wholesaler or distributor, okay, or sponsor. They also call them that, right? It's their commission for this. So when you buy a mutual fund, you pay a front end load, all right, which is of course the public offering price, right? Which is anything over and above the net asset value. So you buy at the public offering price, which is the net asset value with the sales charge added on top of it. And that's to you as an investor is that cost. The expense ratio, right, is not a front end load, right? The front end load is the taken off the top, right? It's the sales charge off the top. The expense ratio is the ongoing operating expenses that a fund has. Taxation, no, it's entirely unrelated to taxation of any kind. No load funds do not impose any of the following fees except A, front end sales charge, B, redemption fee, C, management fee, or D, contingent deferred sales charge. All right. Just real quick though, notice this is an accept question, which means there's 3 truths and a lie. Oh, excuse me. More than that, this becomes a double negative, doesn't it? Okay. Okay, I think we got everybody? I think so. They do not impose any of the fees except, which means which one do they impose? It's a double negative, right? Double negative. That drives me not uncrazy. So the one that they do impose is the management fee. Yes. Okay. A mutual fund is called a management company, and when there's going to be a fund manager, yes, there will be management fees. They don't have front end sales charge. That's the Class A shares. They don't charge redemption fees, and they don't have the contingent deferred sales charge, the CDSC, which is also known as the back end sales charge or back end load for Class B shares. But all funds, if they have management, they have management fees. Under FINRA rules, the maximum sales charge that may be imposed on a mutual fund purchased is A, 5% of the net asset value, B, 5% of the public offering price, C, 8.5% of the net asset value, or D, 8.5% of the public offering price. Okay, I've got 4. Okay. Okay, I think one more person. Okay, I'm going to close this. Okay, final answer. Okay, all right. Okay, great. So FINRA rules: maximum sales charge that may be unopposed is 8.5% of the public offering price. That is the maximum allowable sales charge, and the sales charge is a percentage of the POP, not the NAV. It's basically saying that of this public offer price you're paying, right, no more than 8.5% of that can be going into sales charges. That's what it's saying. Okay, and that is now in the real world. I don't know if there's any fund that charges 8.5%, right? It's just too competitive out there. but that is the maximum allowable under FINRA rules. So, which also, oh, actually, I'm not going to say it just yet because I think I've got a question about it coming up. Okay, so let's go with this one. A mutual fund has a computed net asset value per share of $10.30 and a public offering price of $11. The fund has a sales charge percentage of A, 6.1%, B, 6.4%, C, 7%, or D, 7.5%. Yeah, okay, and yes, you use your calculator. Okay, they give you a calculator at the testing center. So, and I do suggest always use your calculator for any math problem. Okay, it's 4. Okay, so what's the best answer? All right, so how do we figure this out? What's the formula to find the sales charge percentage? What we're going to do is we're going to take the POP minus the NAV, right? The difference between the two prices, because that is the sales charge, right, in dollars and cents. Divide that result by the POP, right, because it's percentage of the pop, not the NAV. So the difference between the two prices is 70 cents. And we take 70 cents divided by $11. Well, crunch that in my calculator, I get 0.06363636. Let's just round that off to 6.4%. Okay. Any question about that? Do you know how, does it make sense how I run the formula? Okay, thanks, Ashley. Next one. Okay. This one's a little busy here. Okay. A customer has purchased $5,000 of a mutual fund. Over the past 5 years, the fund has appreciated $14,000. At this point, the customer wants to buy another $5,000 of the fund. In the prospectus, the breakpoint schedule is, and you can see it there, okay? On the $5,000 purchase, the customer will pay a sales charge of A, 8.5%, B, 7.5%, C, 6.5%, or D, 5.5%. And yes, if you're watching the video recording afterwards, yes, the 5.5% got cut off. It was outside the viewing area. Okay, so we've got 2 people answered. Okay, good. Okay, good. Thanks for writing here. So what this question has to do with, all right, what do they call this? Okay, can you recognize this? Has to do with rights of accumulation. Rights of accumulation is like, it's a way of working your way to get a discounted sales charge, to get a break point. See, if you got a whole big chunk of change, right, you put in a whole lot of money right away, you can get a discounted sales charge, right? The standard sales charge, if you invest $10,000 or less, is 8.5%. But if you bring that up between 10 to 20,000, they'll charge you 7.5. All the way down here to 65,000 or plus, 5%. Okay. And by the way, that discount applies to the entire deposit. It's not laddered. It's not tiered. It's not 8.5% on the first 10,000 and 700% on the next 10,000 and so on. No, it would be on the entire purchase. Now, not everybody's got a big chunk of change, right? So they can work their way to getting discounted sales charges through rights of accumulation. So with rights of accumulation, the amount that they put into it and the appreciation that is made over that time also, right, its value will increase. And once it crosses one of these breakpoint thresholds, then from that point forward, they start getting reduced sales charges. Okay. So the $5,000 initial investment, but has appreciated $14,000. Now it wants to bring in another $5,000, which would bring in a total of $19,000. And if they have $19,000, they fall in the second line. Okay, so they pay a 7.5% sales charge. Okay. With rights of accumulation, appreciation does count. Okay, right? As they keep adding to it, if they reinvest their dividends, sooner or later, their holdings with that mutual fund company will hit one of those breakpoint thresholds. From that point forward, they start getting reduced sales charges. They won't go back and adjust previous purchases, but going forward, they will. Okay. Again, any questions here about letter of sorry, this is rights of accumulation. Yes, Anna.
I may have just read the chart wrong, but so it was the 14 plus the 5.
Mm-hmm.
So that would be fall in the 20,000 bracket. So I thought it was 45, which is the which is the 6.5, isn't it?
Well, the 14 that they have, okay, the positive 5,000 has grown to 14. Add another 5, that's $19,000 total. So that would fall in that second line between 10 and 20.
Okay, thank you.
Okay, sure thing. Now the thing is, of course, if you added just another $1,000 to it, they would knock that down to 6%. Okay. Which statement is true regarding dollar cost averaging? A, if market prices remain constant, the plan will produce a lower average cost per share cost. B, if market prices are fluctuating, the plan will produce a lower average per share cost. C, if prices rise, smaller dollar purchases must be made, while if prices fall, larger dollar purchases must be made. Or D, the plan requires that a constant dollar amount be maintained in equity securities with any excess invested in debt. I am counting four answers. Okay, I think, yep, there is 5. Okay, so dollar cost averaging. What do we know? What is dollar cost averaging? I'll tell you what, if you've got a 401k, you're using dollar cost averaging. You might not even know of it. Okay, it's a strategy, it's an investing strategy of investing regular dollar amounts at regular intervals, right? Once a month, right? A certain dollar amount every once a month. Right? The first mutual fund I ever started with, right? So I just started $50 a month, automatic, right? Or out of every paycheck. So you put the same dollar amount every in, and when market fluctuates, well, when prices are higher, you don't buy as many shares. But when prices are lower, when markets are down, you buy more shares. So that's the idea. Buy more shares when prices are lower, fewer shares when prices are higher. So the way it works out in the long run is that the average cost per share ends up being lower than the average price per share. So the best answer is B, lower average cost per share. See, cost per share is a weighted average, taking into account that more shares are purchased when prices are lower, fewer when prices are higher. Okay, and to figure out cost per share, you just take the total dollars invested over the period of time, divide by the number of shares purchased over that time. That gives you average cost per share. Okay, So that's a strategy for investing in fluctuating markets. Any questions? Because I'm not sure if anybody got that one. So does that make sense or no? Okay. Again, if you're worried, just think about your 401k. The maximum annual 12b1 fee permitted under FINRA rules is A, 0.25%, B, 5.50%, C, 0.75%, or D, 1%. All right, I think that's everybody. Best answer choice is C. Yes, 12b1 fees, which are specifically cover the cost of marketing and distribution for a mutual fund, is 0.75% of average assets per year. Now, by the way, the fee is stated on a yearly basis, 0.75% per year, but the 12b1 fee are charged on a quarterly basis. So every 3 months they tap the mutual funds accounts for the 12b1 fees. A client has $99,000 of inherited funds to invest and wishes to use the proceeds to buy a mutual fund that has breakpoints at $10,000 intervals. The registered representative accepts the customer's purchase order without making any additional disclosures. Which statement is true? A. The representative has acted properly. No additional disclosures are required to be made to the customer. B. The representative was required to tell the customer about the family of funds feature. C. The representative committed a violation known as a breakpoint sale. Or D. The representative has committed a violation known as backing away. Okay, I've got 4 answer choices, 4 answers so far. Okay. All right, get your answers in because I'm going to close out this question. Okay, thank you. So what's happened, right? The customer said they're at $99,000 and they break points at $10,000 intervals, and they said I want to invest $99,000 into it. Well, is that okay? Is there an issue here? There is an issue here from the registered representative because he should have mentioned, hey, if you have another $1,000 you can put into it, you're going to get a lower sales charge. He should have mentioned that. So failing to take someone about a break point, a reduced sales charge, that is known as a break point sale. Yes. Okay. A backing away, that is a violation too. That's for dealers or market makers in securities. When they post the price and size of their trade that they're willing to buy, the price and volume they're willing to buy it or sell for, they're expected to honor that quote. Failing to honor that quote is called backing away. I'm not sure what a family of funds feature is. The closest thing I can think of is the redemption ability. If you sell your ABC growth fund and use the money to buy the ABC balance fund, you usually don't have to pay a second sales charge as long as you keep it at the same fund family. Yes, Hannah?
So a couple questions back with the breakpoint chart. If they added the 1,000, they would have been in the one lower bracket. This
Yeah.
one, yes. So is that then considered a breakpoint violation if they didn't mention that?
Figure if I think your rule of thumb here for the test is if someone's like 10% with one of those breakpoint thresholds, then yes, the rep should mention that. So in fact, this one was is a total of $19,000, gets a breakpoint at 20,000. that's $1,000 difference. That's less than 10%. That's like, so yeah. So whoever took that order should have mentioned if you bring in another 1,000, you get a breakpoint. Now, if the customer, by the way, says, no, I want to do exactly what I just said I want to do. I want to invest $99,000. You've done your job, okay? You've made the disclosure. They've made an informed decision. I didn't say it was a wise one, but it was an informed one.
Would the rep, out of curiosity, would the rep have to notate that somewhere that they did mention
Mhm.
that, but the client
I've never,
declined?
I've never seen anything like in the textbook or test that ever mentioned that, but I would say in practice, probably yes. Okay, as just a good, protect yourself move. Okay. Which of the following funds must be closed end? A, NAV $20, purchase price $20. B, NAV $20, purchase price $20.50. C, NAV $20, purchase price $19.50. D, NAV $20, purchase price $20.25. Okay, I think I've counted everyone's answer here. So which must be a closed-end fund? Now remember what you know about open-end versus closed-end funds. Open-end funds, the price is based on a formula, right? Net asset value. Okay, if you add a sales charge on top of that, then you have the public offering price, which is of course the price people buy it. Closed-end funds are traded like stocks. So their price is based on supply and demand at that particular moment, what people are willing to buy or sell for. Closed-end funds do have a net asset value in the sense of an intrinsic, mathematically derived net worth per share value. But what really matters is what people are willing to buy or sell for, the market price. In a closed-end fund, the fund could be trading less than its net asset value if the demand is low for it, right? If there's a low demand for it, then maybe the market price has gone down. Someone would have to sell at a price less than its actual net worth value. But that is impossible in an open-end fund because open-end funds trade at their net asset value. Then you put a sales charge on top of that, and that gives you the public offering price. So there's no such thing as a negative sales charge, right? With an open-end fund, you cannot buy it for less than the net asset value. You can with a closed-end fund because it could be based on a market price. Choice A, which people chose here, well, if the NAV and purchase price are identical, it's either one. It could be a closed-end fund where its actual market price is the same as its net asset value, but that would be kind of a coincidence. Or, of course, it could be a no-load fund because with a no-load fund, there is no sales charge, nothing to add on top of the NAV to give you a higher public offering price. Okay, so A could be an open-end fund, but if it were, it would be a no-load fund. B and D, well, from this information alone, you can't tell for sure. But there is another rule. Remember that the maximum allowable sales charge is 8.5%. So if you see a spread between the net asset value and the purchase price more than 8.5%, that cannot legally be an open-end fund. But it could be a closed-end fund because closed-end funds are supply and demand. If a regulated mutual fund pays out a dividend and capital gains distribution, which the shareholder has automatically reinvested, which statement is true? A, the dividend is taxable. B, the capital gain is taxable. C, both the dividend and the capital gain are taxable. D, neither the dividend nor the capital gain are taxable. Kimberly, I think you answered before I even finished asking the question. You read the questions. Okay, which is good. Which is good. No need to wait for me to ramble on. Okay, I've got 4 answers right in. And, oh, okay, I'm waiting. I'm waiting. Okay, choice. Okay. All right. So for regulated mutual fund, now what does it mean? What does that mean? Regulated mutual fund, right? That means it's in compliance with the tax code, right? With subchapter M, which of the tax code, which is known as pipeline or conduit theory. That's the one that says, just like Angelique says, right, required to distribute minimum 90% of net income to investors and pay it out as a dividend. So, and the shareholders automatically reinvest it. That means it says, don't send me a check. Use those distribution funds just to buy more shares of the fund. Well, okay, well, whichever one they take it, whether they take their dividends or distributions in cash or have it reinvested, either way, it's still a taxable event. It's still income to you. What you chose to do, that was up to you. They're both taxable. I know this firsthand, right? Because I got mutual funds. I set them up for automatic reinvestment. I still get a 1099 form from them, though. That tells me what my distributions were and what I owe taxes on, even though I didn't get a check to help me pay the taxes, so it reduces my refund. Okay. No, it's not. Okay. When you sell your own mutual fund shares, yes. Yes, those are taxable when you redeem your own mutual fund shares, right? So you as an investor, when you sell your shares, you'll show a capital gain, hopefully, potentially a capital loss, but it's a taxable event that year. The distributions, however, okay, those are your share of the profits that the mutual fund generated. So when the fund manager buys and sells at a profit, you as an investor get your share of those profits as a capital gain distribution. Your keyword distribution tells you it came from the fund. Okay. Oh, you need to call your advisor. Yes, Kimberly, I think I saw your hand, your virtual hand.
I
Please.
think you answered it there at the end because
Oh,
I know so the capital gains tax is a higher
uh-huh.
rate,
Well,
but is it
well, capital gains is a lower rate, right? It's a long-term capital gain.
right? But you have to pay capital gains taxes, right?
Yes.
If you do the distribution, that was the key word is the distribution.
You get the distribution, yes. Okay. If you get the distribution, that's your share of the profits that the fund generates. And there's
But in this particular question where it's talking about this is just tax at your normal tax, your ordinary taxable rate.
well, they didn't actually specify one way or the other in this question. But as long as we're into it, the dividend distribution would be taxed as ordinary income. Remember, the dividend comes from the investment income, right? From the interest or dividends that the fund's assets receives. Then the fund deducts expenses and distributes minimum 90% of what's left to investors. Now, unless it tells you otherwise, you'll just go ahead and assume that's just ordinary income taxed at their regular rate. Now, the capital gain distribution, here's the thing. You know there are both short-term and long-term capital gains, which tax are at different rates. The deal here again, the whole concept of the pipeline theory or conduit theory, the mutual fund is basically passing money along like a money funnel. So if the fund held an investment for more than a year and sold it at a profit, the fund has a long-term capital gain. Each investor gets their share as a long-term capital gain distribution, and that'll be taxed at the preferential rate. For most people, is 15%. If the fund held an investment for a year or less and sold it at a profit, the fund is a short-term capital gain. Each investor in the fund gets a short-term capital gain distribution, and that's taxed as ordinary income. If it doesn't tell you otherwise, and it usually doesn't, just go ahead and assume that any capital gains are long-term and dividend distributions are ordinary income. Okay, unless you got some reason to think otherwise. I'm hoping that helped answer your question. All right, thanks, Kimberly. Okay, Amy's going to call your advice. That's funny, Amy. Thanks. All the following would reduce the net asset value per share of a mutual fund except A, asset depreciation, B, asset appreciation, C, capital gains distribution, D, dividend distribution. All right, everyone's heard their answer, and I think everyone got this one. Yes, asset appreciation. And you notice, right, this was an except question. All would reduce except, which means we find the one that would increase the net asset value. And of course, if the value of the funds in the portfolio, as they increase, the net asset value, net worth per share increases too. The distributions, whether they're capital gain or dividend, they reduce the net asset value by the exact amount of the distribution. So let's say the fund pays out a 25 cents a share dividend distribution and a 10 cents a share capital gain distribution. The net asset value will be reduced by 35 cents a share. Just like if you wrote some checks, right? If you wrote checks to someone, that's going to reduce your net worth too. And let's see. All the following statements are true about exchange-traded index funds, except exchange-traded index funds. A, typically have the same or lower expense ratios than index mutual funds. B, can be traded anytime during exchange trading hours at net asset value. C, can be purchased on margin. D, can be traded at no commission cost to the customer. We got everybody? I think we do. All the following statements are true about exchange-traded index funds, except which one is the lie? Do they have the same or lower expense ratios than index funds? Yes. ETFs, they're famous. It's their whole deal. It's their thing. Low costs and expenses, often lower than many mutual funds. That's one of the big attractions of it, because lower costs mean higher profits. Can they be traded anytime during exchange traded hours? Well, that's what exchange traded means, doesn't it? They are listed and traded on a stock exchange. They're bought and sold just like any other stock. Since they're bought and sold like any other stock, they can be purchased on margin. You can't buy index mutual funds on margin, but you can with index funds, with exchange traded funds. Can they be traded with no commission? Well, that's the big downside. They trade like stocks. That means there's a commission for buying and selling them. So that's the one, that's the false statement. Yeah, there's a commission for trading them, which again, for small investors or active traders, right, those commissions can start chipping away at their total profits. But all the others, exchange traded funds, remember you can place limit orders on them, you can place stop orders on them, you can buy them on margin, you can sell them short, you can day trade them. You can't do that with mutual funds. But yeah, the big downside, and it's an important one. Yeah, there's a commission for trading them. I know a lot of online firms say that no commissions now, but look, the typical thing is they do have commissions. Okay, since that was anybody have a question about that? Any part of that that's not real clear? Okay. All right, I think that's the last one I have on funds. So let's go into our next part here. Yes, this is about markets. Our second one's about trading markets. The second market is A, auction market, B, negotiated market, C, unregulated market, or D, primary market. Got three so far. Okay, okay, there's 4. Okay. All right, you can get your answer in because I need to close out this question. Okay. Okay, I'm going to close this game. Okay, so what's the second market? Okay, the second market, now remember, is part of the secondary market. Watch out for that. They try to have a tricky vocabulary sometimes. The second market refers to the over-the-counter market, OTC, which is the dealer market, right? Where there are dealers in securities, and you're basically shopping around all the different securities dealers for the best price. Like if you want to buy a car, you can call up all the car dealers and see who'll give the best price. Well, now you're shopping around the securities dealers and negotiating for the best price. The second market is over-the-counter is a negotiated market. Which one's the auction market? Right? The first market, which refers to trading on listed securities on a stock exchange, that is an auction market. They're all regulated markets. And remember, primary market is issuing newly created securities for the first time to ground floor investors, whereas secondary market is trading between investors. Stock options trade on the A, NASDAQ, B, CME, C, CBOE, D, CBOT. Okay. No problem changing answers. All right, a few more seconds. All right, answer them. You got. Give it a guess. Okay, if nothing else, you got a 1 in 4 chance. All right, stock options trade on the National Association of Securities Dealers Automated Quotation System. No, that's for trading stocks. The Chicago Mercantile Exchange. No, that's for trading. That's for trading futures. So is the Chicago Board of Trade. But options are traded on the Chicago Board Options Exchange. Yes, the CBOE, CBO. Now that's the primary options exchange. There are others too, but that's the primary one. And the CBO is the primary self-regulatory organization for the listed options industry. Oh, you missed the word options. Oh, you stopped. Okay. Oh, you stopped. Read carefully. Remember, one word makes the difference. And they might try and hide the one word in the middle of a long question. All right, we're at the top of the hour right now. I think it's a good time to take another break, and we'll pick up where we left off. Other than that, we'll see. Again, do you want me to go back to another slide? You got a question for me? Anything that kind of stuff, if you just need something, please feel free, okay? And I'll see you in a few minutes. Okay, and just make sure I am welcoming you back. Can you confirm that you can still see and hear me? Okay, thank you, everybody. And if we're ready for our next question, a customer placed an order to sell 100 shares of ABC stock that he cannot deliver by settlement date. The order ticket should be marked A, sell market, B, sell GTC, C, sell long, or D, sell short. Okay, 1, 2, 3, 4, 5. Yep, I think everyone's answered. Okay, some difference of opinion here, but we place an order to sell 100 shares which cannot be delivered by settlement date. Well, if you can't deliver it by the time it needs to be delivered, then you have to borrow it. Okay, in that case, we order the ticket as sell short. As will be a short sale. Now, if you actually own the stock, and sells it short to deliver later on, that's known as short against the box. That's where you're both long and short at the same time, right? You own it and you owe it at the same time. Now, one reason they do that is, again, you can't deliver it by settlement date. Maybe because the phrase short against the box, what do you mean by a box? Because historically, people would have paper stock certificates with their names on it, okay? And they keep them in a safety deposit box. So sell it short now, but I'll deliver it later on when I get to my safety deposit box. People used to do that as kind of a tax game. By selling it short now, they basically kind of locked in their price. They deliver it like, sell it short in December, deliver it in January to defer the capital gain until next year. Okay, that loophole has been closed. All the other ones, though, if you place a sell order, you represent that you own it and can make delivery on time. Yeah, like I said, Amy, that was no longer done. Right, that's correct. Okay. All right, let's try the next one. A customer placed an order to buy bonds. The order reads buy 5M ABC 9s M35 at 90 GTC. This customer has entered A, stop order to buy at 90, B, limit order to buy at 90, C, market order to buy, D, stop limit order to buy. Okay, I think that's everyone. And what do we got here? Buy 5M of 9 ABC 9s at 5M. What a shorthand notation that is, right? At 90 GTC. Well, the fact that they put it the at 90, that 90 is the price that they want to pay. And there's no other qualifiers about it except that it's an order is good till canceled, which means it's an opening standing order. This represents a limit order to buy at 90. So this says if the price comes down to 90, buy it. If it's above 90, they won't buy it because it's more than they're willing to pay. What does that 5M mean? The M is Latin for mil, meaning 1,000. So it's 5,000 face value, meaning 5 bonds. ABC corporate, that's from ABC Corporation. The 9S means that it's a 9% coupon. The small letter S means semi-annual interest payments. And the M stands for, the other M stands for matures. Right? The bond matures in 2035. Okay, GTC, again, that means good till canceled. That means the order is an open standing order until either the order gets fulfilled at their price, or the customer cancels the order, or some period of time goes by and the order expires. Okay, good. All right, then, if it was a market order, it would just say buy at market. There wouldn't be a price after the at sign. Okay, and market orders are instant execution, so you wouldn't have it as an open standing instruction because it's going to get executed immediately. To be a stop order, it would have to say stop. It would have to be like buy at 90 stop to say it was a stop order to buy at 90. It would have to specifically say so. If it doesn't say so, it's understood that it's a limit order. All the following statements are true regarding stop orders except A, stop orders can protect the profit on a long stock position. B, stop orders can limit a loss on a long stock position. C, stop orders allow a specific execution price to be locked in. D, stop orders are placed away from the current market. Okay, I think that's 4. I've answered. Okay, a few more seconds. So guess if you're not sure. Okay. All the following are true except, right? What's the false statement here? The false statement is C, because a stop order does not allow for a specific price. Because stop orders means they set a stop price, which is a trigger or activation price. When it says if that stock ever trades at or through their stop price. If it touches it or crosses it, then, but only then, the order becomes activated and becomes a market order once activated. And as a market order, it's going to trade at the next best available price, whatever that might be. And I mean whatever. So it can be executed at, above, or below the stop price, and maybe even significantly above or below it. Okay. They can use them to protect the profit on a long stock, or to limit loss on or at least try to limit losses on a short stock, on a long stock position. And yes, you place the order away from the current market. Okay, because you don't want to place it like right at the market because the order would execute immediately. Okay, stop orders, especially if it's a sell if you own the stock, they place a sell order, right? And the stop price will be placed below the current price, saying if it goes down to this price, sell. To either try and protect the profit if it's gone up from where you bought it. You bought it at 50, it's gone to 60. All right, sell it if it goes down to 55. Or you bought it for $50 and you say, all right, if it goes down to 45, sell. Try and limit your losses that way. Okay. Regulators do not like, okay, it helps to know that, I'm not sure if I told you this, but stop orders used to be called stop loss orders. That's usually the way people enter them. They're trying to limit their losses. Regulators do not like the term stop loss because it is misleading. It can't actually prevent a loss because it's just a trigger price that trades at the next, whatever the price is at market price, if that stock is ever triggered. So what happens if there's a gap? What if the stock, bad news comes out and the stock like drops in half overnight? Well, you can't lock it, right? So it would just sell it half of what it was yesterday, right? So that happens. So that's why regulators do not like the term stop loss, although many people sometimes still use it. But we'll call them just stop orders now. Okay. Oh, that was my last one. That was it. Okay. Let me go ahead and pause the recording here. All right. All right. So that was the last question I had in that deck. I've got 2 possible options, and maybe you can tell me which you prefer. I can bring up a Kahoot if you like on the similar topics, or would you like to instead use the extra time until 8:45 and just go in and log into Past Perfect and just crank out some of your quizzes and score some more points? Kahoots. Okay. Or option 2. Okay. All right. Some difference. Okay. Difference of opinion. Okay. Well, we got the tiebreaker. Okay. Hang on a sec. Okay. I think the gang's all here. So let's log in. Let's play Family Feud. Which of the following describes the result of a 1-for-2 reverse stock split? A, twice as many shares at half the original price. B, half as many shares at twice the original price. C, twice as many shares at the same price. Or D, half as many shares at the same price. Right, a little difference of opinion here, but remember, in a reverse stock split, 1-for-2, you get 1 share for every 2 that you have now. You end up with half the number of shares, each at twice the price. Yes. Had I said it was a 2-for-1 stock split, then the other would be true, right? Then twice as many shares at half the price. But the price the number of shares and the price always have to change proportionally because the total value has to stay the same before and after a split. Okay? A stock split is like cutting a pie into more slices, right? Twice as many slices, each half the size. A reverse stock split is like welding slices of pie back together. Half as many slices, each twice the size. but you always have the same total amount of pie. That part doesn't change. Okay, are you good? All right, let's see who scored some points. All right, Ashley and Hannah taking the lead. Okay, and keep in mind, remember, the faster you answer, right, the more points you score. Let's go to our next one. Grace Owen owns 100 shares of XYZ stock at $50 per share when XYZ declared a 2-for-1 split. Which of the following is true? A, she now has fewer shares at a lower cost basis. B, she now has more shares at a lower cost basis. C, she now has more shares at a higher cost basis. Or D, she has now fewer shares at a higher cost basis. Right, again, right, with the stock split 2-for-1, you get 2 shares for every one you have, twice the number, half the price. So more shares, now each price, now a lower cost basis per share. Basically half of what she paid for it is now her new adjusted cost basis per share. Okay, and again, had it been a reverse split, 1 for 2, then D would have been the best choice. Okay, Kimberly putting on some points now. Let's check our next one. Each of the following activities would be deemed by market regulators to be manipulative behavior except A, market close, B, proxy solicitation, C, or D, cap. Okay, the one that's actually considered okay is proxy solicitation. Yeah, that's when you're trying to, well, maybe someone's trying to convince someone else to vote their proxy, right? Because shareholders vote by proxy and do so the way they'd like them to vote. Okay. The other one's marking the open or close. That's basically placing false trades either at the beginning trade or the end trade to try and influence what's seen in the newspaper next day. Nobody picked front running. That's good because that's a violation too. That's sticking your trade in ahead of a customer's trade. And capping is illegal. Basically, again, it's illegal market manipulation of selling to try and keep the price of the stock down, try and keep it low. Okay. Okay, let's see here. Oh, okay, Kimberly moving up and Colby putting on some points. Nice. The SEC requires that notice of corporate actions be given for all the following except A, interest payments on the issuer's debt instruments. B, dividend payments on issuer's common stock. C, the issuance of warrants to be attached to a bond offering. D, a reverse split on the issuer's common stock. Indeed, right? The one that you don't have to give notice for because it's paying interest on debts, on bonds. Why? Because, well, you already know it's part of the bond contract. It's part of the bond indenture that the bond will pay its interest on a regular every 6 months. So that's not an extraordinary event. Actually, but even dividend payments, aren't they paid quarterly? Remember that the dividend is entirely at the discretion of the company's board of directors and how much the dividend will be. So yes, the SEC does say they have to make a public announcement when they're going to pay the stock dividends, right? When do they make that announcement? Right? On the declaration date. Okay. Issuing warrants too, yes, and a reverse split, because that also, right, that restructures the company's stock holdings. It restructures the corporation. So that not only requires notice, but also requires a shareholder vote. Voters, right, shareholders have to approve splits and reverse splits. All right, let's see. Okay, Amy's got some points now. Hannah's in the lead. Colby's right behind. Let's check it out. You own 400 shares of stock and received notice of a stock split. You now own 1,200 shares. The split must have been A, a forward uneven split, B, a reverse uneven split, C, a forward even split, or D, a reverse even split. Awesome. Okay, great. All right. Okay, good. You knew it had to be a forward split because you started with fewer and now you have more shares. That's a forward split. A reverse split, you end up with fewer shares. So you knew that couldn't be it. And it was proportional, wasn't it? 400 down to 1,200, right? An even proportion. In fact, it must have been a 3-for-1 stock split. Okay, because it would just have to be, right, mathematically. Good. And that, of course, anything 4-1 is an even split. Good. All right, Colby's 3 in a row. Hannah maintains the lead. All right. Oh, and it's a real horse race between Colby and Ashley. Okay. Kimberly's not too far behind. Let's check our next one. Scram Corp is appealing directly to the holders of IDNIC Corp to acquire shares of IDNIC stock. This appeal is A, a sell-off with IDNIC as the target company. B, an acquisition. C, a hostile takeover with IDNIC as the target company. D, a buyback with Scram as the target company. All right, well, no one quite picked this one, but because they're going directly to the shareholders to acquire their stock, they're making a tender offer on the company stock. Yeah, that's a hostile takeover. Okay, they're making an offer to existing shares of IDNIC Corporation that says, I'll buy your stock from you at this price, right? And the price is probably higher than the current market price, which makes it a pretty attractive offer. And remember, once somebody, if Scram Corp, they buy 51, if they own 51% of the stock, they own the company. Okay, so yes. Okay, so that would be a hostile takeover because they're going directly to investors. An acquisition, close, but an acquisition is not done by, well, it's basically done by negotiating, with the corporation, right? With the corporation itself. Okay, rather than just going straight to the investor and saying, I'll buy your shares out from under you. Okay. Okay. All right, let's see. Next question is, a stock is at risk of failing to maintain the minimum price requirements to remain on the NYSE. The corporation should A, have a reverse split, B, increase earnings, C, reduce staff, or D, declare a stock dividend. Perfect. Yes. Have a reverse split because they're falling below the minimum price. Well, if they do a reverse split, have fewer shares at a higher price per share, they'll be at the minimum price. Okay. Increasing earnings is always a good idea, but you can't absolutely guarantee that even if you increase earnings, that investors are going to start buying the stock and move the price back up because maybe investors think it's not sustainable. Reducing staff, I don't think that's going to help much. Declaring a stock dividend, of course, would be the actual opposite thing they should do, because when they do that, right, the price per share reduces proportionally. So that's not a good idea now. All right. Hannah maintains the lead. Kimberly moves a space upwards. A corporation divests itself of all the shares of another company it owns. This is known as A, a recapitalization, B, a spin-off, C, an acquisition, D, a merger. Yeah, right. When there's divesting, if the company it owns, right, a subsidiary of the company makes it its own independent company, that's known as a spin-off. Right. Recent spin-off. Well, first off, there was an acquisition, okay, where eBay acquired PayPal, right? Bought up PayPal and became a subsidiary of eBay. Well, later on, several years later, they decided to separate them again, and now PayPal is a spin-off from eBay. Okay. Expedia, right? The online travel agency, that's a spin-off from Microsoft. So yeah, so that's when the subsidiary becomes an independently separate company. Okay, let's see. All right, Kimberly got that one and moved into first place. Wow. Okay, right. Cheers for Kimberly. Okay. A customer owns 1,000 shares of stock subject to a 2-for-3 reverse stock split. This position will now consist of A, fewer shares with more per share within the same net position value. B, fewer shares worth less per share with a decreased net position value. C, more shares worth less per share with the same net position value. Or D, more shares with more per share with an increased net position value. Okay, again, as always with the stock split or reverse split, the total net position, right, the total value has to stay the same before and after. So yes, and of course, being a 2-for-3 reverse split, you get 2 shares for every 3 that you have now, 2/3 the number, 3 halves the price, or 1.5 times the price. Fewer shares with more per share. That's the best answer choice. Again, please remember, if you need any help with this, please feel free to let me know, okay? All right, Colby moving into first place now. Oh, wow, what a horse race this has been. All right. In a 20% stock dividend, what happens to the number of shares and the price? A, the share price goes up and the number of shares go down. B, the share price goes up and the number of shares go up. C, the share price goes down and the number of shares go up. D, the share price goes down and the number of shares go up. Oh, so it was cool. Good on you. Right. In a 20% stock dividend, what's a stock dividend? The company is basically rewarding shareholders by giving them more shares of stock. 20% more. Someone had 1,000 shares, now they'll own 1,200 shares. But again, the total value has to stay the same. So while the number of shares will increase, the value per share reduces proportionally, so the total value stays the same before and after the dividend. Share price goes down, number of shares goes up. Okay, Hannah moves into second place. Colby maintains the lead. Okay. You own 500 shares of MES stock, and there is a 2-for-1 forward split when the stock's price is $10 a share. You have A, 1,000 shares worth $10 per share, 250 shares worth $20 per share, C, 500 shares worth $20 per share, or D, 1,000 shares worth $20 per share. Right, 2-for-1 forward split. Twice the number, half the price. 500 shares at $10 becomes 1,000 shares at $5, which is still the same, all right, a $5,000 total. And you can always do a checksum, by the way, right? When you do the math on it, do a checksum. Make say the same, the totals are same before and after the split, so you know you did the math right. Okay. If it were 250 shares at $20 a share, well, what would that end up being looking like? Has to be half the number, but twice the price. No, that sounds more like a reverse, a 1-for-2 reverse split. Okay. Amy's 3 in a row, moves into third place. Colby, whoa, down 4. Okay, Hannah's in first place. Man, what a. Okay, yay, Hannah, right. A party wishing to solicit proxy authority to vote a particular stock shares must register with A, the Financial Industry Regulatory Authority, B, the regional exchange where the stock is traded, C, the New York Stock Exchange, or D, the Securities and Exchange Commission. This was a tough one, yes, okay, but you knew it had to be a regulator, okay? Not, I know the stock exchanges are also self-regulatory organizations, but not who does, okay? Would it be FINRA or would it be the SEC? Well, because of this particular right, this is not so much about trading between investors, right? It's about basically proxy authority, right? Trying to get people to vote the way they want to kind of control the company. So the Securities and Exchange Commission. Remember, we talked before about proxy solicitation is not considered a market manipulation, but they do have to be known to the SEC. Amy's in first place. Okay. Colby moves into third. Wow. Oh. You bought 100 shares of ABC at $50 per share and received a 10% stock dividend. What do you have now? A, 100 shares at $44.45. B, 110 shares at $45.45. C, 100 shares at $50. D, 110 shares at Good show, right? You knew it had to increase the number, right? 10% stock dividend. You end up with 10% more shares than you have now. So the number of shares would increase, not stay the same. But if the number of shares increase, then the value or price per share must decrease proportionally. So 110 shares at $45.45 is still, still $5,000, at least rounded to the nearest penny. Colby's back in first place, Kimberly in second. My goodness, it's just, oh, I can barely keep up. What a roller coaster. For securities held in the street name, which of the following is true? A, the broker-dealer is the beneficial owner. B, the customer is the named or nominal owner. C, the customer is the beneficial owner. D, the bank accepting securities as collateral is the beneficial. All right, some difference of opinion here. This was a tough one. Securities held in street name. What is that? Well, first off, what does that mean? Held in street name. Okay, remember, most people keep their investments in their accounts at the broker-dealer firm. Not that many people will hold a paper stock certificate that's got their name on it. Okay, so therefore the transfer agent, right, who keeps track of the shareholders, they'll only see that the shares are held at the broker-dealer. Okay, that's all they'll see, right? They won't know who the actual customer is. So all the mailing they have to do, mailing dividend checks, mailing proxy statements, annual reports, right? They got to send it to the broker-dealer, who then forwards it to the customer, because the broker-dealer has got the list of who owns what shares. But it is the customer's property. That's what they mean by the beneficial owner. They'll have benefit of it. Now, the broker-dealer, however, no, they're the nominal owner or the named owner, because on the transfer agent's books, it said these shares are held at, I don't know, Ameritrade or Smith Barney or, I don't know, where else could it be? Robinhood, whoever it is. All right, let's see who moved up here. Kimberly in first place. My goodness. And okay, yes, kudos, Kimberly. Yay, Team Kimberly. Which of the following are not requirements for corporate actions? A, notify the customer of the payment or distribution date. B, notify the customer of the title of the security. C, notify the customer prior to the payment of the semi-annual interest payment. Or D, notify the customer of the declaration date. Yes, remember, not required for corporate actions. They do not have to notify them about the semi-annual interest payment because, again, like the question before, it's already in the bond indenture, right? It's already in the contract that they'll pay interest semi-annually, so you don't need to make a special announcement. All the other ones, yeah, they have to be announced. All right. Kimberly, 3 in a row and maintains the lead. What happens next? Last question. Which of the following would lead to a standardized cost basis adjustment for stockholders? A, spinoff. B, merger. C, dividend. Or D, takeover. I know, I'm looking at the... All right, I am so impressed. Okay, that would be a standardized cost basis adjustment. Yes, everything else would not be standardized because every deal is unique. So yeah, there has to be a cost basis adjustment, whether there's a merger, takeover, but it's not standardized. Every deal is different. But the dividend, yeah, that's standardized, right? Okay. Hey, that was great. Okay. And by the way, my aunt used to have a cat that would do that too, except that, okay, it's like, it's time to wake up and feed me kind of thing. Okay, you tap on the face. But the thing is, if it didn't work, if you didn't get, then the cat would extend the claw, right? And do right up the nose. Okay, so yeah, that got your attention. Glad you like that, Ashley. Well, let's see how we did. And in third place, bronze medalist is me. In second place, silver medalist is Colby. And in first place, gold medal and Olympic champion, Kimberly. All right. Yeah, okay. All kinds of kudos for Kimberly. All right, fantastic. All right, and this is it. We're at quarter to the top of the hour, right? At 8:45. It's the time I'm supposed to let you out the door. Folks, again, please get if I haven't had a chance to check your scores, I'm gonna do that. That's great. Yes, I remember I have to do that manually. So each and every time. Let me close that out for a bit here. So again, I have to do that manually. So okay, so I haven't had a chance to do it, but I will soon. Please get make sure you get to episode. That way we can get you your get you your passing grade, get you your your voucher. You can take your test, and you already had a chance to see tonight what kind of things are kind of waiting for you there. What kind of opportunities exist. So we'll see you again next Monday. As always, remember, you've got my email address. Email me if you need me. My offer still stands, right? I'll set up a one-on-one call with you. We'll talk on the phone, any topic you like. Interestingly enough, I'm having a hard time getting people to take me up on the offer. So set yourself apart, okay? Contact me and let's set up a time to talk. All right, let me close out the recording. So we'll see you again next time, everybody. Same bat time, same bat channel. Take care. Good night, everyone.
Thank you. Good night.
My pleasure, Hannah.